I'm with Haran Karunakaran, Investment Director, Capital Group. Haran, thanks very much for presenting at the Investment Leaders Forum, Byron Bay.
Thanks for having me, James.
What are the key factors driving the performance of investment-grade credit markets right now in mid-2024?
Well, so I think the big thing is the yield that's being offered by investment-grade bonds. So globally today, that's about 5.5% on average. That's the main driver of returns, and that will continue to be for the next few years. On top of that, you have the potential for rate cuts or rate rises, and that causes day-to-day fluctuations in prices, and that's been a big driver, particularly over the last year, in a positive way.
How should investors adjust their strategies in response to persistent inflation and changing interest rates?
Well, yeah, I think the changing interest rate environment in particular is a game changer for how portfolios should be constructed. The big thing I would say is for investors to think about adding duration into their portfolios. That's been a big underweight for most advisors. I think in an environment where rates are staying higher for longer and then potentially going down, adding duration is going to be a very good proposition in most portfolios.
In what way does the liquidity profile of investment-grade credit impact the resilience of portfolios?
Well, liquidity is a hugely important and I think often underappreciated risk for portfolio construction. In the good times, all asset classes are liquid. It's only when there are market stress events that come about that you see that certain asset classes, areas like private credit, to a lesser extent bank loans, to a lesser extent high yield, start to have some liquidity problems. Areas like investment grade corporates and sovereign bonds tend to be pretty resilient throughout the cycle.
What are your predictions for the investment grade credit market over the next 12 months?
I think it's a great time to be investing in investment grade credit. Over a specific 12-month time horizon, I think it's really hard to pinpoint. But if I take a 12 to 36-month horizon view, I'd be pretty comfortable in expecting mid to high single-digit returns for investment grades, around about 8%. And how I get there is pretty simple. You start with a 5.5% income yield. You add potentially 1% on top of that through active management, so finding those individual bonds that will go up in price. And then the third layer is potential for rate cuts, which would add another 1 to 2% over that time period. So again, 8 to 9%, a pretty comfortable expectation.
Haran, we've seen rates reset quickly. Why should investors consider lending to corporates when sovereign yields have recently become more attractive?
Yeah, so in a higher rate environment, with rates potentially coming down, duration is very attractive, and there are different ways to get that duration. Traditionally, it's been through sovereign bonds. I'd argue investment grade corporate's a better option today because it offers a higher income relative to sovereign bonds, about 1 to 1.5% over what you get on sovereign bonds, and offers a lot of the defensive characteristics that sovereign bonds offer. Sovereign bonds, I think, would be more favorable if we're entering an environment where there's a high chance of a severe recession. But given that's not what we face today, I think investment grade corporates can play that defensive role while giving you a higher return potential.
Haran Karunakaran, Investment Director at Capital Group, thank you very much.
Thank you.